Good morning, everybody. This is Dennis Wilmer with the Active Trend Traders. Welcome to the How to Make Money Trading Stocks webinar that we do every Friday at 10 o'clock. I got a question. I've been looking at ways to basically make this be a little bit more productive, and I'm thinking about sliding the webinar to the 11:30 time frame, and that way anything that is highlighted during the from 11:30 to 12:30 could be acted on prior to the close of the market. I mean, you can act on the things that we talk about from 10 to 11, but it would close it down a little bit closer to the end of market. If that sounds like something that would be interesting, please just shoot me a note saying, yeah, that sounds like good, and that sounds like something we could work with. Mike and Michael, I don't know how you guys would do 11:30.
Which time zone?
California, man.
Okay.
The Pacific.
So what's the time currently?
10 o'clock.
Okay, well, for me, that's fine.
Okay.
Oh, okay. So you're thinking of switching from 10 o'clock California time to 11:30 California time?
Yeah. Just as a thought. I mean, I haven't made a decision on that yet, but just I want to get feedback from folks. So in other words, we would be on for an hour, but still leave 30 minutes prior to the close for people to, if they needed to act on something. It might give us also a little bit better indication of what's going to happen into the close on Friday. Okay. So that's a thought. Like I said, yeah, sometimes hard access, depending on what time zone you live in, that could be not a good time for you because this is kind of like the time zone that coordinates pretty well with the East Coast for lunchtime. And so let's get going. I want to remind everybody that all the materials that we do present here are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. Here's Michael's disclaimer for his work in Europe. He works he's an investment advisor, an independent investment advisor for a Swiss wealth management company. So I'm going to turn there we go, turn those off. At the Active Trend Trader, we really believe in training, and this past week we had training on just some simple option strategies that can be utilized for folks, and then we immediately put those into action the following day. Got into some trades with that. This coming week, April 13th, which is a Wednesday, we'll start at 6:30 in the afternoon. I want to highlight that this is going to be, I'm going to make this open to anybody who would like to attend this webinar. So, please invite your, if you're a premium member of Active Trend Trading, please share with your friends, neighbors, families, enemies. Next week, we're going to be talking about base hits or home runs and highlighting the areas of when it is advisable to swing for the fences, because there are certain times in our trading where the probability of successful trade is highest at certain levels, and that's when one can, in fact, perhaps go in with a little bit more, buy a little bit more, and with expectations that it's going to work out well. So we're going to be highlighting that. I think it's a good topic and a good topic to share with multiple friends. I know, Mike, you are very succinct on when it is time for you to personally just swing for the fences, and I know that since you only trade like 3 to 5 times a year, basically you do not necessarily follow a plan that leaves you what do they call it? Not divested, but when you're
not diversified.
Not diversified, yes.
Well, I mean diversified in that my trade limited to the indexes, and I'm not doing much single stocks. So if you want to consider that diversification because it's an index and not a single stock, but just based on my preferences and methodology, most of my trades I'm swinging for the fences because I'm going all in, or mostly all in with a full position size when I'm really convinced that it's worthwhile to do something, instead of maybe not having a lot of conviction and not putting much size just to see what's going to happen with something.
Right. And so, anyway.
Although I did that this week.
You did what this week?
Took not a full-size position and did something that I don't usually do.
Okay. Are you going to share what you did?
For the first time ever, I traded one of the VIX ETFs.
Okay.
And I wanted to do it. I saw the setup there, and it's a way basically of shorting the market, but going long on an invert, on the VIX, and so I did it. I did it using VXX,
okay.
and for me it wasn't a full-size position. I made a little bit of money, and I got out of it in a couple of days, and happy to have done that. But it wasn't my usual thing.
Okay. No, that's good to know. I've highlighted here a couple of other ETFs. These aren't connected to the index as much as they're connected to the XLF, which is the financial ETF. One is in the direction of the financial ETF. The other one is and that's FAX. Or correction, that's FAZ. There we go. That's a Z. FAS and FAZ. If you want to see some really great looking patterns, primarily, these show really good looking patterns. And some people trade the ETFs. Some people trade the VIX all the time, simply because it provides a good, it provides good solid technical patterns, and there's not a darn thing wrong with that. So this week.
Sorry, FAS, it's the same as XLF, I guess. So XLF, I think it's the biggest one.
Yeah, FAS is the leveraged version of the XLF.
Okay, I see.
Okay, so this week, we're hanging close to resistance. We haven't totally broken down from it. It's a fairly uneventful week. I think we've seen on the S&P, it's been a very interesting battle royale between the buyers and sellers. I mentioned last night in yesterday's market update that the 8-day moving average on the S&P has worked as both has not worked as either a level of resistance and or a level of support, and that it kind of has had the consistency of a pad of butter. The NASDAQ is at resistance, but holding the 8-day moving average, as at least it was, and the Russell. The big question on the Russell is, if the market does roll over, will the Russell lead? Which way is it going to lead? Is it going to lead the market down, or is it going to basically hold where it is and lead with a rebound? At this point, of course, we don't know the answer to that question, but hopefully we'll be finding out over the next week or so. Earnings start up mid-month. They actually start up. Some earnings are going to start coming out next week and the following week, and then the last week in April. Fed meeting at the end of the month. There'll be a lot of speculations going into the Fed, because the Fed's kind of sending us cross messages. And what I mean by that is that some of the Fed presidents are speaking very hawkishly about raising interest rates. Others are speaking very dovishly about, no, we're not going to raise rates until such and such and such a thing happen. And so either Mike or Michael, any comment on the Fed? It doesn't have to be a positive comment.
How much time do we have?
You got 3 minutes, man.
I don't think I can do it in 3 minutes.
Okay. All I know is I think one of the things the Fed is doing by sending these cross messages, I think it's trying to send a message to the market that the Fed is in control, and they will dictate how the market, which way the market goes and how it goes there. So we have some volatility returning this week. Mike, I'm assuming you played the VIX up to the upside.
Yes, I did.
Okay, so some volatility returning, and then finally beware April 15th, which is next Friday. One, make sure you have either your tax extension in or your taxes done, and at that point we may see the market drop off a little bit simply because the 401ks and the IRAs will have been funded, and that may, in fact, with now fresh dollars coming into the market, it may slow things down a little bit going into the end of the month. We're still anticipating or looking.
Then we have monthly option expiry date on Friday.
Yeah, next Friday is monthly options. Not quite as wild as the quarterly option expiration when you have a triple witching hour, but yeah, it is a monthly option expiration time frame. So we'll be looking at what's going on into April 15th. What else we got going on? Here's where we were last week. We were sitting at about 64% on the percentage of stocks above the 20-day moving average. This week we actually fell a little bit from that, and what looked to be, this was a really interesting market this week from the perspective of how things fell and then rebounded and then fell and rebounded, then fell. And then, of course, we got a little bit of a rebound today. It was almost as if one could have almost gone in, bought the close or sold the close on the up days and bought the close on the down days. And but who wants to trade that way? I mean, that's yeah, but anyway, because the market is kind of wet and wild right now, it's not giving us a lot of good indications of where and what to jump into. As we can see, we have dropped below the, I use an 8-day moving average line on this just to give me some points of reference. And as we can see, we have dropped down below it. And again, this indicator comes in, we get interested in it when it drops below the 30 level, because that oftentimes is indicative of a potential turnaround in the market. And that's where we're looking at our other indicators to try to jump on a trade at that point. Mike, you got anything here? I mean, it's not telling us anything except it's stuck in the middle again.
No, it's not really telling us anything. The way it's shaping up and where it's at today, it's just kind of inactionable.
Yeah.
Things are just sort of, bouncing around kind of sideways. Like you said, you're down one day, you're up the next day, and just sort of directionless right now.
Yeah. So, and that brings us to the larger perspective is the percentage of stocks in the NYSE and this index that are above their 200-day moving average. And as you can see, we spiked up to finish off March. We've come down just a little bit. We're only 45% of the stocks are above their 200-day moving average. And again, I keep reminding folks, and we've got, and this is a monthly chart, but the S&P, or this is the spiders, if you will, are working within this triangle. Now, if you look on a daily chart or a weekly chart with candles or a bar chart, what you'll see is we have a level of support about there, and a level of resistance about there. And that corresponds to, come over here, the 210 down to just above the 190 level for the level of support. You have to remember that when we dropped here, it basically finished the month at, about just above 190 or at 190, but it actually had fallen during the month all the way down to this level, which corresponded to the about the 180 level. Are we going to revisit that moving forward? At this point, we don't know. And when we get to the index charts, we'll take a look and see how price action is operating within the downtrending channel that is evident on the S&P chart. And so Dave indicates that, April 15th usually a short-term bullish seasonal. Up until then, David, and then oftentimes after the 15th, things kind of, because people are in a hurry to, they're just shoving money at their 401ks and into their IRAs to make the 15th cutoff. And let's see here. What else we got here? Joe asked, Dennis, do you use inverse ETFs during market declines? And the answer is yes. And we're waiting for a setup. Actually, we're waiting for a setup on the inverse index ETFs right currently. Go ahead. Michael, did you say something?
No.
Okay. Mike, did you say something?
Nope.
Okay. So here's where we were at approximately 9 o'clock this morning. The markets were down from where they were last week. As you can see, the S&P is just barely holding its head above the break-even point for the year so far. Here were the highs that we hit back in 2015. The Russell is down more. It actually has dropped down more than it was last week. Same thing for the NASDAQ Composite and the NASDAQ 100. I'm sitting there keeping my eye on. So let's take a look at the charts. There we go. The S&P. I have been highlighting this and highlighted this in the market update yesterday. We had a really nice head and shoulders show up on the true strength indicator, and then it, whoops. Then it broke below the neckline here, and that happened, a couple of days ago. And then it finally, the momentum of the TSI and the momentum on the daily charts are pointed down. And one of the things that is kind of interesting also is while the momentum on the weekly chart is, has basically actually taken out the highs from the last move up is good. We're getting the cross signal where it looks like the TSI is trying to turn around, and so we'll see how that how that comes out through the going into next week. If we finish where we are right now, and the S&P just basically, if this was the end of the market day, we would have a dark cloud, which is a bearish reversal signal. The weekly chart gives a very good indication of the downtrending channel that price action is still stuck in. It came right up to the tip, to the downtrending line, and reversed actually starting Monday, Tuesday, Wednesday, Thursday, Friday. And so that is our hard level of resistance. And we'll see if this leads to further downside move going into next week. One of the things it could do, similarly to what it did back here in October, November, December of last year, is you had a couple of just stability days and then our weeks, and then you got your big drops. This drop from here to here is about 4.8%. The drop from here to here, 1975 is also about 4.8%. And so if you get, and as you can see, we zigzagged around for several weeks in a row in a higher trend channel, if you will, until it finally broke out the bottom side of that in the January timeframe, followed it on down first part of January through about the third week in January, and then we get the rebound, and then we get a second rebound coming up the early part of February. So as it stands right now, we could either zigzag around in here as long as this trend line remains intact. That's telling us that it increases the probability that we are going to retrace and fall down to this trend line. Can it stop anywhere along the way and rebound? Sure. And if it does, that one in a way would be more of a bullish type signal, like if it gets down to the 1900 level or even the 1950 level and then rebounds. One could interpret that as, okay, now we have a higher low in place, and that can, that has its own bullish type of considerations. Mike or Michael, any comments?
Well, my only comment, but you've already kind of alluded to it. I mean, we've built a pretty well-defined channel here on the weekly chart, and within that channel, it's a downtrending channel. So we're seeing, lower highs and lower lows, and until that kind of polarity changes, which means we would have to see either a higher low and then a higher high. I think we have a pretty well-established longer-term weekly downtrend in place here.
And so, yeah, without a doubt. And it becomes even more evident when we look at things like the Russell. I want to pop over here real quick. Harry, I see your question, and I will get with that. I recognize this is the first week of the month in April, so we can't really make any determinations off of this candle other than to say, okay, it is holding. One of the things, the action from last month actually stopped the decline in the 8-period moving average, is the 8-month moving average. And so, however, if we fall again down into these levels, it will reverse this moving average, the 8-period moving average, back to a downward position. At this point, it almost looks like we're just getting another squeeze. The problem is our momentum that is over here is not necessarily positive. It's below the zero line. Same thing with the TSI. Harry asked a question: why do I use the 8 day EMA, and I use the 8 week, and I use the 8-period moving average. I find it to be a little bit more effective, Harry, from the aspect of timing. There are several trend traders out there who do use the 8-day moving average, and sometimes it can give you a leg up on the folks who are just using the 10-day. The 10-day is, like you said, it's used by a lot of people in the financial world, and that's great. But I find that it just gives us a little bit of an edge over just using the 8 and the 10. When we do our training about moving averages, what I always encourage folks to do is choose one. If you're going to use the 8-day, use the 8-day, but stick with it. If you're going to use the 10-day, stick with that. Mike or Michael, you got anything you want to add on using moving averages?
Well, again, I mean, my only comment is what you just said. Whatever you're using, whatever works for you, and the way you eye things and see things, stick with it. I mean, in the overall scheme of things, there isn't a big difference between an 8 and a 10-day moving average. The 8's relatively uncommon, so it isn't being followed by a lot of the big institutional traders like the 10 is, or the 20, or the 50. just whatever works with you, stay with it.
Exactly. And so
Yeah. Once I read a book about this. It's one of Al Gore, future trader, who has quite a impressive track record, and he said he uses 10 and 100.
yeah.
But
I mean,
so
yeah,
100 for the overall picture, and 10 for the daily picture.
and so and I know some traders, they will use, they use the 30-50 crossovers and all that kind of stuff. And so again, it gets back to learning one. I also then know some traders who didn't trade very well. They would basically change the moving average to match the chart that they were, the stock that they were trying. And so they would sometimes use the 10, sometimes use the 12, whatever matched the individual stock or ETF they were trading. And I find that just, does not lead to consistency.
Yeah, agree.
And so a couple of things here. Here is the one thing I want to point out. Here's NASDAQ. NASDAQ is in the process. If we close where we are today on the weekly basis, we will have a bearish harami in place on the NASDAQ. Again, we have similar things going on down here with the TSI trying to turn over. We've already had a break of the trend line on the TSI here, which tends to indicate that we're going to get additional downside until these indicators get at least to the zero line or below. Right now, we have not seen anything that's reversing it. We've got some level of support in here, which is at approximately the 44-45 level. We've got the 200-day moving average. We got the 100 and the 50, which is very interesting. It's right there in a level of support at the 43.78. If we slip a fib retracement on this, and I have to fix one thing. I want to turn on the 23.6. Save as default this time. Save. Okay. Look at this 23.6 retracement of this larger move up here. Actually works out with this former support, and we have both the 50-day and the 100-day moving average coming up to greet that level. So that would be a potential good level of support for the NASDAQ. I'll drop this out really quick, remove drawing. Downside, and I had a box over here. One of the things that we like to take a look at is we are still have a pretty nice extension away from the moving averages. The 820, the 820 has crossed, but we have a good indication that there could be some additional drop here. But if we project that line upward, where's it going to be next week? It's going to be about the 4,400 level. I think that's 4,400 level. And so to provide potential support as things move going into next week. Anything surprising here, Mike or Michael?
And not directly related to this, but have you the Russell? Yeah, exactly. It concerns the Russell.
Okay. Well, it's a good time to go Russell then.
Yeah. To my knowledge, there is no European index like a Russell, but I read or I attended an interesting seminar of a big asset management company focused on Europe, and it's quite impressive. If you take, I think it doesn't matter Russell versus SPY a 3 or 10 year chart, then the difference is not big. Or just in contrast, I think S&P is slightly better.
Right.
And in the last year, definitely. And in Europe, the picture is totally different. So basically you could say year after year, small caps are doing better than large caps. And I don't have the answer why. I just forwarded slides to a guy who said he will analyze this further. It's quite interesting.
And so, yeah, Mike, have you done any? Now, Michael, what you're saying is that the big caps have done better than the small caps
in the US, but definitely not in Europe. Just the other way around.
Okay, over what time frame?
About 10 years, but you can also take 3 years. So it's pretty consistent.
Mike, in your investigations, have you found anything that along that line?
Well, historically, over long periods of time, small caps tend to outperform the larger cap stocks, meaning, if you were to go look at it, over a period of 20 to 30 years, you'd see the Russell probably outperform, the S&P and the Dow.
Right.
But, that doesn't mean that it's like that in every time frame that you can, choose. And certainly we see from looking at the charts that we're looking at now, and we're looking at weekly charts, which, cover a year and a half to 2 years, certainly the Russell has been the weaker, during that time frame. And that's just an observation. I'm not even going to venture into trying to put out a guess as to why that is. It just is, at least for now. But over long periods of time, 10, 15, 20 years or more, there is a tendency for the small caps to outperform.
Well, I know when we did the initial back testing for the early warning system, that's one of the things we noticed, and we back tested it utilizing the IWM or the Russell primarily, and now we did some also on the S&P, but we noticed that there was a larger return typically on the Russell or the small cap index. As we can see last year, though, the Russell underperformed. I mean, it was, here's the beginning of 2015 here, and it did go up, and it actually rolled over sooner than, it rolled over mid June, and then it fell out of bed really hard compared to the other markets. And so what I'm seeing on the Russell is we've worked our way back up into both horizontal support, resistance, and it is rolling back over. It has failed to reach this downtrend line, which is indicative that the Russell is weaker than the other indexes. And that's where I mention and talk about oftentimes it can lead because it is, and I think can be more reflective of the underlying or the internal strength of the stocks on the markets, because it's not a weighted index. We haven't had a discussion about weighted indexes for quite a while. But what you see here is there is no weighting on the Russell, and where over, last year we saw the S&P, the NASDAQ being held up by, the fangs, if you will, and the fangs have kind of fallen out of bed here, and so that helped with the downtrend with the S&P and the NASDAQ. But with the Russell, it's more of the raw data about what's going on with, a large, what is it, 2,000 stocks in the Russell, approximately?
Right, 2,000, and it is a non-cap weighted index. I mean, each one of those stocks is worth the same as any of the others in terms of the weighting towards the index. Correct.
And so what we see here, I mean, classic downtrend. And we've got one leg down, 2 legs down, and oftentimes that third leg down will be the most violent. So it's going to be interesting to keep our eye on what's going on. And that's where one of the highlights I want to highlight to folks is, take a look at the index, the inverse index ETFs. I'll be covering those on this week's Traders Report. Since all topping, every topping pattern is typically a process. Since the inverse index ETFs go inverse to the index itself, a lot of times their bottoming, rather than being an event, their bottoming is kind of more of a process. But once they explode up, it can be very interesting, and we may be approaching a point where we'll start getting a little bit of explosion. Again, if this pattern stays in the symmetry of this pattern stays into effect, then if this is leading to the next leg down, this leg down could be quite significant. Now it may, here's one thing that could happen, we may drive sideways like this and stay within this trading range until we hit the line over here. When would that be? That would be at the beginning of May of this year. That corresponds with kind of the theory that we're working from, is that this year's market is a lot like the market in 2008. It drove, it basically bounced around, had some good trading ranges, but once it got, but then in the May to later May timeframe is when it finally broke down and fell real hard in 2008. Again, that's the theory that we're working from. Yeah, Michael.
Dennis, have you any idea how volatility was in 2008? Because volatility is absolutely crazy low.
Yes.
I mean, also today, today it's a good example. Not a lot going on, but a clear trend reversal in intraday, and VIX going down, not up.
This goes back 20 years. I don't know if. Oh darn! Hold on just a second. Let me get the other.
Maybe I can find. Just...
I think it's is it VIX or backslash?
Yeah, VIX. Yeah, you might want to go to VIX.
Yeah, we'll go to VIX. Okay, this is a weekly chart over here. This should get us back into, here we go. So what was going on back in, there's 2000 and 2006.
Oh, okay.
And here is, okay, here's 2000. Oh, here we go, right here. It had come down to a low. This is when basically the market ripped to the bottom. It was about May, June 2008. And as you can see, it had gotten back down to a low about 15 to 16, 17, down to slightly in the 15s. But it was at its low compared to the past months, and then it just ripped higher and moved very, very quickly back up to the 90 level. And so what are we seeing going on today? We're seeing that, yes, the VIX is retesting down around its low of supports. This time we are at a lower number, which is 11.9 to 12, 11.9, and it looks like it's getting ready to potentially rip higher. As you can see, typically the importance of this is when the VIX tends to turn up, oftentimes the market tends to turn down. And so it's something to keep your eye on. Mike, but as you can see, we didn't, even over going into last year when the market fell out of bed in October, the VIX didn't get up all that high. I mean, on a weekly basis, it got up to 52, nowhere near the 90 level that it did back in 2008. Mike, you got any comments on that?
Well, yeah, I have a few actually. The VIX chart is going to be almost a mirror image or the inverse of the S&P chart, just because of what the VIX is. VXX is a leveraged way, a leveraged ETF for the VIX. So if you're anticipating that the market maybe is going to fall,
yeah,
you if you want to do something about that and you want to basically essentially kind of short the market without actually taking a short position. A lot of people might be using retirement accounts to do their trading. You cannot shorten a retirement account. You can only go long. Well, you can go long, the VXX, which is a way of shorting the market, and then try to play it that way. And the other point I wanted to make, and this is just in terms of looking at charts, a lot of people, and I don't know if I'm one of them or not, I might be, a lot of people, their eyes are just trained maybe to see things that are going up. And so they tend to be able to read bottoms better than they can read tops. And sometimes the charts on, the inverse ETFs can, show some subtle things that are a little bit different or more pronounced than on charts of the indexes themselves. So if you go back to the daily chart of the VIX here.
Well, of course you would ask me to do that. Hold on.
Of course I would.
Okay. There you go.
So here's a good example. I mean, if you look at the the daily chart of the S&P, yes, it is possible to see some subtle negative divergences setting up over the past week or so. But if you look at the daily chart of the VIX, there is a not so subtle positive divergence. As the VIX is putting in lower lows, you're getting a higher low in the True Strength Index and certainly a notable higher low in the Momentum Index. And that's why I made the trade this week that I made. And because I saw that, and it's certainly more pronounced and easier to visualize than it is trying to see the negative divergences on the S&P chart.
Yep.
And it's just another way to look at things. You're trying to, build some conviction in your mind. You're trying to develop a convergence of many clues. And it was just easier for me to visualize it this way. Even on the VXX chart on the daily, you can see that TSI divergence and the momentum divergence. Maybe a little bit easier than I could see the negative divergence on the index chart itself. And just another way of looking at things. And there's nothing wrong with that. Some people, will look at tops and be able to read them better than they can visualize bottoms, and that's great. But the point is, sometimes it's helpful to look at some other charts to try to get a little more clear picture of what could be setting up.
And that's where I was sharing with folks early on the essence of FAS, which is the directional ETF, leverage ETF that goes with the XLF, FAS, and FAZ, FAZ. Again, really, as you can see, this is the inverse. And Mike, you're getting some of the same kind of movement on this. It's got great volume. I mean, it does about 1.3 million a day. But just this little move here this past week has taken us from a low with positive divergence, a real quick move of,
it's about 10%.
About 10%.
Yeah, and also with the VXX, there was about a 10% move there.
Cool. So
it may be a little more than 10% actually from low to high this week.
Yep.
The point being, I would recommend to people that they, number one, know themselves well enough to know how they look at charts and what they see and how they see things better, and then to look at some alternative charts to see if that doesn't help to provide a different or a more clear picture at times when there seems to be some kind of an inflection point, setting up.
Exactly. And I wanted to highlight one is on these inverses. So I'm talking about is, you go in and you look at either, TZA, SQQQ, SPXU, and what we saw earlier in October, November, and into December before it took off on these big gains is you saw this kind of basing type pattern here. And those of you who've done the study and done the, were in on the training session about the reversion to the mean, believe it or not, it actually works with anything you can chart, actually. And eventually you get this nice formation of a base, and it launched out of here. And as you can see on FAZ, when it went hyperbolic, I mean, that's one heck of a run within a very short period of time. Again, it's a little bit less traditional. But if you're trading something like this, the only thing you got to be concerned with is a little bit of news, and also news, not earnings news or anything like that. But as you can see, this is a very volatile chart. But you have to basically read the technicals on it. And you know, what are we getting right now? We're breaking out above this high here. And so this could be basically making a turnaround. It may fall back down here and do some retesting, but it'll be forming a base like it did over here. And then if this market does continue to act the way it did, you know, does something similar to 2008 in the May-June time frame, that may be the time where things could start breaking down and provide some you know, additional trading opportunities. So there we have.
And I've got one last tip to share with people. If you can go back to the daily chart of the VIX.
I can. And Tracy, to your comment, VXX is the ETF for the VIX. And SH, I don't, you know, is SH the inverse of the SPY?
SH is the inverse of the SPY, and it's either non-leveraged or maybe the double,
okay,
the two-time leverage
okay,
for the inverse of the SPY. It might be the non-leveraged.
Okay.
Yeah, in fact, I think it is the non-leveraged inverse SPY.
Okay.
Well, the tip I was going to share here, you know, with the VIX, you know, whenever there's a sell-off in the market, and you're looking at the candlesticks on the VIX, and you see, and we're strictly talking about closing prices here, but if you start to see, you know, situations where for maybe, you know, 3-4 days in a row that the closing price of the VIX is markedly removed or above the 8-day EMA, as it was here in early January, you're going to get a reversion to the mean, and that reversion to the mean means that the VIX is likely to fall back, and if the VIX is likely to fall back, then the selling's done, and you're likely to get a bounce in the indexes.
Right.
It happened here in mid-December, and it happened here. You can see when the selling was done, at least for a period of time, in mid-January, and you got these closes up here around 28, which were way removed from the moving averages. Right. It was time for the selling to be done, which is exactly what happened. And the inverse of that, if you look at the chart of the SPX, you would see the price action getting away from the 8-day EMA to the down, you know, to the downside.
Yeah, and the big thing, and I know that you would suggest the same thing, Mike, is that with these, you know, waiting for the proper moment is absolutely crucial. So where it solves one problem, you don't have to necessarily go and look for individual stocks to trade. You can just stick with the ETFs and you know, trade those. But this is looking, yeah, this is looking very positive on both a daily basis, excuse me, and also the weekly. I mean, we've come down here, we've got this low down here at 113. And so this is kind of a level of support. It's come down and hit that. It's bouncing now. It needs to break back above the 8. But, you know, any type of retesting down here may provide an opportunity with the expectation that you're going to run back up here if the market gets really weak, back up here to the 128, to the the 28 to the 30 level. or even just to the top of the moving average band, because from there to the top of the band is about, in this case, it's about 65%. Interesting. So, okay, let's continue on. Let's wrap up so we can look at some stocks. So that's where we're at with that. This was a chart that was in the Traders Reports from an article that Mike did over the weekend. I got all kinds of great comments. This is a quarterly chart, and currently we are still, prices are still under the dome.
I was wondering if you were going to use this anywhere outside of that article.
Hey, I've used this so much. I mean, gosh, I used it at the BAM meeting last week. Just an excellent chart. It's a quarterly chart. Mike, you just want to kind of give some of the highlights on what we're looking at with this chart? I mean, we've got the cross, but going to the profit charts, this cross has actually tightened up. It's gone back into more of a squeeze type of thing.
Well, I haven't. It's a quarterly chart, so you're really only going to get information on this at the end of the quarter. At the end of the 3 months. I mean, every candlestick on this chart is 3 months of price action.
Right.
You're only going to get four candlesticks per calendar year, and this is really sort of a bigger picture perspective of the S&P, and the point of this, and certainly I didn't make this up. I copied and pasted it from having read it and seen it somewhere else. But there were 2 points to this chart. Number one, the guy who put this chart together, put his time parameters on the MACD, the oscillator at the bottom of the chart. He put them where he put them, and he's trying to show how predictable, with the slow movement of the price action on this chart, how predictable the MACD crossovers have been over the last 20 years. They don't occur very often, but when they do, you get very predictable follow-through to both the upside and the downside in the S&P, number one. Number two, when you can take a quarter's worth, 3 months worth of price action and condense it into a candlestick, it really kind of makes you sit back so that you can see the forest a little bit better and not get caught up with the individual trees. And some of the similarities between what we're seeing now in relatively real time, the past 3 to 4 quarters, which really is the past year, and what we've seen at market tops over the last 20 years. And we're seeing topping type candlestick signals here. We certainly have a hanging man for the first quarter of 2016. We had a hanging man near the end of 2014. We've got a shooting star in there in 2015, and a doji. And then we go back and look at what happened in leading up to the dot-com crash. And 2001, we had a couple of consecutive hanging man candlesticks there. Leading up to the sell-off in 2008, there was a hanging man candlestick followed by a doji type candlestick. And it's just a bigger picture, more macro way of looking at things. And so the chart's really presenting that information. The MACD information and the candlestick information. And not only that, but again, looking at the MACD on the bottom, you can see the histogram portion of the MACD, which is a bar type way to look at the difference between the two lines on the MACD, and how they're starting to come together, close together, as we've had this very long consolidation of price action in the S&P in this 1900 to 2100 range, or 1800 to 2100 range, but the negative divergence in the MACD histogram that has been developing during that time.
Yep. And so, yeah, great charts. Let's see, Chris, Tracy asked, no, okay, wait, hold on a second. We got a couple of questions. Chris asked, based on the chart, it appears we should have a major decline. And Chris, that's kind of the point. But again, keeping, Mike says, don't lose sight of the tree. What is it? Tree for the forest or forest for the trees? Recognize.
You want to be able to see the forest, not get caught up in the trees.
Yeah, is recognizing that this is a huge trading range, and and from an aspect of patience, that's critical. And we're in the process of making a new candle. What would be a lot of fun is again on, and then Joe asked, what kind of type of account do you have to generate this graph or this chart on stock charts? I don't know.
Yeah, that's a good question. Stockcharts.com has, a free service that they provide, which I utilize occasionally. And then they have a subscription service, and different levels of subscription service give you different levels of being able to do things. And you cannot do a quarterly chart of this sort without paying something for a subscription. I'm not sure what level of service you need, but you do have to pay for it. You can't get a quarterly chart for free there.
Okay. Now, if you are a Thinkorswim user, and you can go to the profit charts, which is I'll just pop that up really quick and bring it over. You can go to the profit charts, which are, hold on just a second.
Even Thinkorswim doesn't offer quarterly charts. They only offer the monthlies.
On the Thinkorswim charts, they do not. You're absolutely right. But
I haven't looked at charts.
But on profit charts, let me bring this across here. On profit charts is where you go to charts, profit.
You can do quarterly charts on profit. You can do yearly or annual charts on profit charts.
You can do it on profit chart, and we'll see if that'll load up. And there we go. See, I've got this set up for annual as we speak. And as you can see, let's go take a look at the S&P. And yes, it is still in effect. This cross has in fact taken place. Let me get rid of all those other drawings. I mean, they're good drawings, but they're... and so as you can see, yes, we have had the cross, and I also have the TSA on this. A lot of fun. One of the things that I think would provide some, maybe another time for research and all that kind of stuff, is to go in on individual stocks, long-term stocks, because you get up something like a Tesla or something like that, it's not going to be, because it hasn't been around long enough. But if you go to something like an Apple, what are look at this, and I don't know if it has the same meaning or not, Mike, but at the same time, it does look like, at least over the last couple of years, that these big declines happen right after a cross here. Now, you might not be the full decline, but at least it was telling you were in trouble. And if you blow this up to look at some of these other ones, you'll see that you were getting a similar type thing on some of these other drops. But that's it for the aspect of that. Anyway, path of least resistance, I'll let everybody figure that out on your own. I think that we are at resistance. Gino says, any recent market commentary from Bill O'Neill? I've got to watch some of the recordings that took place this past week. Mike, do you have the quarterly chart on a monthly setup? Well, that was my setup, and that was a quarterly chart on the TOS charts, or it's on Thinkorswim, but it's under profit charts under the charting aspect. So yeah, here's right. We got blood out of the water on the Tesla trade this week, hit. But the spider trade came back and bailed us out a little bit. Have not opened, we've opened 3 positions. Here's where we're sitting so far on our equity curve for the year. I'm expecting just a really awesome month in the month of February. And then the next BAM meeting is the first Saturday in May. What we'll be doing is using indicators correctly, and that will not be with Ashish Devi, that'll be with me. Again, free training webinar on Wednesday. Please, share once you get your invitation. Please feel free to share that with whomever you would like. And as we always, I focus on the 5 pillars of active trend trading: what to trade, top quality IBD growth stocks, index ETFs, and the versions that are both the inverse and the leveraged. When to enter, when to exit, what strategy we're going to use, and what to expect. I know that some were saying, gosh, are we ever going to be trading in strategy number 1 again? Yes, we got a couple of trades going on that. Some of them are going with us. Some of them are not. They're pre-earnings trades. We've got a couple of options in strategy 2, and we'll continue with our wealth building. The Tesla trade on that is up close to a little bit over 40% since we opened the position in October last year. And so we've got the base, the underlying paid for. And so now every week that we have a profitable trade, it just adds to the amount that we're Tracy's saying I got the wrong shirt on in this. Anyway.
Well, looks good to me.
Well, that's where I went to school at. Between there and Cal. And lastly, if you're watching this and you've, please, I invite you to join us at the Active Trend Traders. For folks who do watch this webinar or the recording of it, we offer a discounted membership for both the early warning alerts and the Active Trend Trading membership. So, Mike, thank you for, I hope you all really, we got into some really good stuff today about just taking a bigger picture on what's going on in the market. And I hope that resonates with folks as you prepare going into this weekend. Again, this weekend I'm going to be working on just assessing, evaluating when we want to perhaps get into the inverse leveraged index ETFs, because if we continue to build a base as it appears that the market is going into a kind of a topping process for maybe a short-term pullback, those inverse index ETFs, they basically move up as the market falls on a 3 to 1 ratio on a daily basis. So see you guys next week. Have a great weekend. Mike, you got any final words?
No, not really. Just glad to be able to get out of the house now today.
Yeah, and Mike had some skin deals done, and they kept him out of the sun for
48 hours. I have not been able to leave the house, at least not until the sun went down.
And so you were like a vampire, right?
Yeah, very much. Yeah, very much so.
Okay. Hey, I got time.
And you don't realize, no matter how nice your house is, the lack of freedom and not being able to leave.
Oh, without a doubt. Without a doubt. And so here's a couple of stocks that I'm watching just to let you know for potential pre-earnings runs. Netflix has earnings coming up on the 18th after market reports, and it's respecting the 20-day line, so we'll see if we get a potential bounce here. Only thing is the TSI and the momentum is a little bit low, but we've got a good positive on the weekly. We'll just draw a real quick trend line in here from basically from here up through there, and I can touch that today. As long as that trend line stays in effect, intact, we should be okay for potential trades to the upside. But the only problem with Netflix is it's hitting its head against that moving average at the 106 level. But we'll see if we can get a breakout prior to earnings. We also open a position in Facebook this week. Facebook got bad news this morning and dropped through our uptrending line that it had held, going back to the 9th of February. Since it's a news-driven event, we'll see how it winds up the day. My big issue is I want it to close above on the weekly chart the 110 level here that shows up. That's where the 8-period moving average is on the weekly chart. The second thing that I'm looking at this, because our 4% stop loss is down about 108, 109 level, right below the 50. And so I'll be evaluating this at the end of the day, and as long as the 110 level stays intact, we'll probably not do any actions on this. It will be nice if the institutions come in and support Facebook prior to the end of the day, and I would like to see them drive prices back up above the 20-day moving average. And Tracy, 50-day moving average bounce, it could very well do that. It did it one time prior here, and as long as we stay above the 50, our stop loss won't get triggered. XRS just about took out the profit mark today. And I find that really interesting. I'll blow this up real quick. As we got into this trade yesterday down here about the $50 mark, and it was based on getting a positive move on momentum and TSI and being above the 8-day moving average. We jumped in here. We pushed up. But look at this extension. My target price to exit with a 5% gain was about 52.64. Prices to this morning, first thing this morning, drove up really hard right out of the gate, hit this 78% retracement, and then reversed down from that. This is looking very positive, and again, pre-earning run, earnings on the 28th. The last one that we're looking at that we've got a position on right now is PayPal. We've got both an option position on and a long stock position in on this one. Again, set up for a pre-earning runs after market close on the 27th for earnings. We'd like to see it continue to hold the 50, break up through this trend line here, and then bounce back up here to the 41 to 42 level prior to earnings. And that would give us a nice little return of about almost 10% prior to earnings once we make the break going out of there. On the option trade that we're doing on this, we're anticipating the volatility to increase into earnings, and that's one of the ways that even if the stock doesn't move a lot, that volatility increase will increase the value of our individual earnings. I got time to look at just a couple of stocks, and I'm going to call it a day, guys. PayPal. Right here is PayPal, George. PayPal, we're in PayPal. Basically, we're in PayPal long at around 38 bucks, a little bit above, that. Again, it's showing that that's got really good support at the 38 level. We just need to push up through this resistance that's formed by the 8 and 20-day moving average and this downtrending line here. If we can break back up, break above that line on some volume, it should put us into a really nice little up pre-earnings run. I'll be looking at, taking off part of the position at probably 5% to 10%, and in between now and the 27th, which is the last week in. So ABX, whoops, ABX. Well, geez, Dennis. There we go. Okay, what is ABX? I always like to. Okay, gold. Okay, super. It's getting a really nice rebound here. Judy, you've got earnings coming up, but volume's coming back up as it came back up off the 8-day moving average, and you got a positive cross 820, and now you're back up at resistance. If you're already in the trade, you can hang on and just watch, make sure that it stays above that 8-day and or 8-week moving average. And if, they say that if interest rates go up, buff. Okay, yeah, so that's what I'm seeing with that. Got pretty good volume picking up, nice gap up. Any type of, the ABX will probably go in the same direction as the FAZ. Financial, Adobe. Okay, major concern on Adobe, it gets a nice, it basically popped up with earnings, fell back down to the 8-day, and the issue that I see with Adobe is basically the volume is drying up, and we're moving sideways, so that's not necessarily negative, but we may need to do some consolidation of the gains here. It may test the 20 before it potentially takes on off again. This, yeah, I mean, it basically got up and did a breakout or came close to a breakout with earnings. However, it didn't close above the breakout. It pulled back from it. So you got hard resistance up here at 96 level. Okay. Buff. What a cool name for whatever this is. Buffalo Wild Wings? Blue Buffalo Pets. Okay. Had earnings a few weeks ago. That's where we get this break up. Earning volume is not bad. Well over 1 million shares. It came back and retested the 8-week at this support level at 22. So Jorge, Jorge, if you're in at 23.38, which is about here. So you must have, did you purchase on the breakout? Over here? Well, let's come back and it's retesting that. I would be concerned if it broke below the 2267 level. Okay. Because if it takes out the low of this hammer right here, that could be a bad sign for you. And secondly, this is not a real healthy daily pattern here. This huge sell-off that wiped out all these past days worth of progress. Plus, we're getting some long-tailed candles at the top of the bodies, which is showing you that that's where the sellers are coming in. So let's see what we're doing here. And okay, I'm going to do one more and then call it a day. Okay. Let's see, I already did one for Judy. Chris. WB. Weebco. Okay, volume on this breakout. Yeah, Chris, you basically, it has, it's broken out from this large V, cup and handle type of pattern. And so you get your breakout here at 19. It's driving up. It is at the far reaches of the moving average envelope, but as we can see in the past, it's basically, you know, followed that up. If you're not already in it from the move from down here, you're going to definitely need some kind of a pullback towards the 8-day moving average before I would think about jumping in it. So, yeah, Kieran, I can do that. If I remember, I will send out the link for the, yeah, short leash on Buff, Jorge. And one last one, IBB. This is the Biotech, I think. Isn't this the Biotech? Yeah, Biotech Index. Looking kind of interesting. I was watching this last year because it was up here really high. And it looks okay. It has basically it is into at least a short-term uptrend. And I say that because you now have a higher high and a higher low. Now, will it maintain that and continue to rise? If you are going to trade this, you're going to basically want to wait for a pullback towards. You know, you'd like to see a nice little uniform pullback. Those big candles there is not that uniform, and so that would provide me some kinds. But this tends to be the biotechs tend to be very volatile by nature, and so you may want to switch over to either go to a weekly chart where you can define some strong levels of support and resistance and plan your trade around those, or go to an intraday chart and you may get some more uniform or type of price action. So with that, guys, I'm going to call it a day, and we will, again, have a great weekend, and God bless everybody.